Bring that ass back like a boom, 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 boom.
Hey everyone, this is Supernova. You're with Boom Traders Weekly Market Overview. And first and foremost, let me say Merry Christmas to every one of you that are celebrating. I hope you had an amazing weekend. Hope you spent some quality time with your family and your loved ones. And I really hope you enjoyed some time off. Now, you know that today is Monday, markets are closed, so I allowed myself one extra day to record this video. And let's get it going. Just as usual, we do have our disclaimers starting with, and the main part of this is that this video is for educational and informational purposes only. There are no financial recommendations made in this video as we are not financial advisors. As far as the session overview, just as usual, we do have the models, the market price action, internal nodes, sentiment, seasonality, and summary of against which the nodes and the market price action and internal. So right after the models, I do have the nodes, and then we're going to take a look at the charts. In general, the market model is on sell signal, and the breakout model is also now working. So for those of you out there who are trading breakouts from bases and similar patterns like flags or channels, we can definitely say that the breakouts are now working at the moment, so it's better to stay either in cash or be very, very fast in your trading. As far as long, mid, and short term, basically months, weeks, and days, we're back to the negative to all of them, just like last week. Pretty much nothing has changed. So the markets do look a bit dull, although they do caught some breath on Friday with all four of them recording positive days. However, volume was extremely low, but of course this was to be expected in the weekend before Christmas. So nothing really surprising here. So let's just jump to the notes, trying to make this video very short and very sweet. One thing that I need you to understand, and I want to start with this, is that this market is driven by inflation. Now, I could have put oil prices in front of inflation, but I decided to keep it like this. But keep in mind, oil prices are a vital part of the inflation right now, largely due to the conflict between Russia and Ukraine, but also due to the unprecedented years of quantitative easing and money printing that we have had since the COVID crash in 2020. So inflation drives the Fed. So basically this is their main motivator for doing whatever they're doing. Then the Fed reacts by raising rates, which in turn, crash the market. So higher rates, lower market, vice versa. And this whole thing starts with inflation. For us to see the market going up, we need inflation going down, thus the Fed stopping these rate hikes, and of course the market would react. Saying this is their the Fed's primary indicator for how inflation is doing, the PCE and the core PCE. So these are the price indices. And you can see right now we are moving around at a point of around 5.5 for the PCE, and the core PCE is this dotted orangish line at about 5%. So it is elevated, nothing like we've seen in the past 30 years. You can see 1990 we had around 5. But of course, during our history, we've seen much higher levels. 1975, 1980, 1981. You can see levels up to 11.5, 12%. So nothing so bad. Although what is actually good to see here is that we are turning down. And I'm hoping that you're seeing here that once we turn down, like right here, like right here, like right here, the only place that we actually stopped was right here for just a little bit. But then that was 1981, but then it just crashed down. So this turn right here is definitely a positive sign. The other thing that is very important to understand here and what is happening to the markets right now is the speed of the tightening, or as they call it in this graph, the pace. And what you see right here with this orangishly brownish line is the current pace, and you can see that it is the fastest tightening pace since 1980s. You can see the 94, 204, 1999, 1986, and 2015. This is the pace at which the Feds were hiking the rates. You can see what's going on right now. And if you look at different graphs showing how markets react to the pace of the tightenings, you will see that the faster that the Fed are tightening the rates, the rates, I'm sorry, the worse it is for the markets. So it is pretty much expected that the markets are going down, and this is what has been happening. Now, one thing that I want you to also understand, and I'll leave you with this thing, we have corrected 25% or so so far from the highs, and this has never happened before recession. Now, I put before here in parentheses just because for some people, we've already had these 2 quarters of negative GDP growth, which officially should have put us into recession. But you know, a recession now is a bad word, so we don't use it, and we kind of switched the definition of recession to fit into this narrative. So we've never had this 25% or so correction before a recession. So that, of course, poses the question: how much is already discounted and what's to be expected? Now, there's some also analysts that are saying that the Fed are actually doing a little bit too much in order to tame inflation that already seems to be slowing down, and are calling for the rates to actually be for the Fed to actually stop these hikes and actually reversing course. There's also been some suggestions that in the event of a black swan thing happening to the markets, the Fed will have to turn around and actually start quantitative easing again, printing money to actually restore the economy. So it's definitely going to be a very interesting 2023. But I just wanted to give you some different perspectives right here, and things to consider when you are investing, because this will most likely affect people who are investing a little bit longer term than the traders, and especially the day traders who really don't need to worry that much about this. Now, let's take a look at the market price section and the charts. These are the 3 charts that I mainly use to monitor the market: the S&P, the QQQ, and the IWM. Let's start with the S&P 500. And this is a little bit of a longer term look. You can see that we're definitely in a downtrend. We have been rejected first by this trend line already 4 or 5 times. So we had it once, twice, 3, 4 times, and we haven't been able to close above it. And also you can see this purple line is 200-day moving average. So once we crossed back right here, we tested once this zone right here, we were rejected, and then it pretty much coincides with this trend line right here a little bit lower, but still only a couple of closes above this 200-day moving average, and we're back. We have also crossed the yellow line is the 50-day moving average. We have also crossed the 50-day moving average from below, tested once, and that was on Wednesday, trying to poke, rejected. Then what happened on Thursday, you can see we gapped down, pretty good volume on the downside, but we were able to close near the open, so no major damage done here. We closed the gap right here between Tuesday and Wednesday, no major damage done here, and we actually closed right on Friday we closed. We actually tested the low of this candle, which was important. It was the day before this huge move right here. I told you that I'm looking for some support and resistance all around the lows. We stopped dead in here. So good action on Friday. Of course, volume was little. That was to be expected before the Christmas weekend. As I mentioned already, the good thing is that we actually gapped down in the beginning, but we made a higher low. See, we couldn't get below the low of Tuesday and also this low, and we closed near the open on Thursday. So not definitely not bad action for S&P 500, but if you look at the overall picture, we are below the 50-day moving average, we are below the 200-day moving average. And something that I have as a note on the IWM, you will see we are actually trying to make some higher lows. So we have this curling right here. You can see like we made one low, we make a lower low, but then we start making some higher lows. So in my way of thinking right here, this is the most recent low that we did, and we had some volume right here. You can see these cyan bars. We had some volume coming off of the low, so some support definitely. And what I'm looking for right now and right here is if we can hold these lows. If we start dropping, can we hold these lows right here? If we can't, then naturally that will be a lower low than this one. So I would confirm my bearish stance at the moment. If not, things are not looking this bad. Now let's take a look at the QQQ. And I do have some drawings from the weekly chart. So let's first go to the weekly chart. And you can see that we are very close to this key reversal bar right here on the weekly. That happened a long time ago, September 2021, but we are very close to it. However, on another note, we are forming a bearish flag that we just broke last week to the downside. So we are in pretty much no man's land. Now let's go back to the daily. And if we go back to the daily, you will see that we are testing the low of pretty much the same structure or on the S&P 500 when I showed you, but we actually stopped right here before this bearish candle. Now we are testing this low right here, which was I thinking that we'll be testing on the S&P 500 as well. We stopped right there on Thursday. Friday we almost tested it. We had some reaction, but very little candle. Again, low volume, nothing really surprising here given that it was the Christmas weekend. We are still below these dotted lines are the bear flag that I showed you on the weekly. So we are below the bear flag. And if we can flip that and go back into the flag, I would consider that to be a mild zone of support. So this might be a good place, of course, if we have some volume to trigger some longs into the upper side of the bear flag. But again, I would consider this just as a bear market rally, nothing more at this point. And last but not least is the IWM. The only thing that I have on the IWM, it is starting to curl right here. You can see after this huge drop, we are making higher lows, as I mentioned on the S&P 500. Same thing right here, and we are higher than these lows right here as well. So this is forming a real good turning point. Of course, we do have the lower highs on top, which is not ideal in this situation, but it's up to see. I don't really see how you can trade this. It's a very strange pattern formation right now. So I think that the best thing that you can do right here is just monitor the price action. So with this, let me take you to the internals. We're going to take a look at a few things to decipher the market's inner workings, and then we're going to take a very fast look at sentiment and seasonality. So the first thing I want to show you right here, and you know this graph is comparison between the SPX and the NASDAQ composite, is that, and that's a line chart of course, but on a line chart you can definitely see that we are making lower low right here on NASDAQ and a little bit of a higher low on the SPX. However, the indicators here, the oscillators that I use, are definitely bouncing off of the oversold zone. You can see also the spike breadth rest and McClellan oscillator coming into range minus 100 to plus 100. And the Nasdaq, especially price action, is not confirming this. It is a little bit confirmed by the S&P 500, but the fact that we are back into the mid zone and price is not advancing ever slightly on the indices, it's a bad sign. So definitely these are moving, but this is not. So price action is really weak. Now let's take a look at the other chart that I use for the internals. First, looking at the put call ratio, we had extremely elevated levels of 1.38. Now we're back to 94. That's on the daily. If you look at the five-day moving average, we are above 104, which signals fear in the market participants, and that's not necessarily a bad thing. As far as new highs and new lows, both the New York Stock Exchange and Nasdaq are recording again sessions with negative values. You can see we've been very few times over the zero throughout the year, so the net new highs have been more than the net new lows. VIX at 20.87 at the moment, dropping. On Friday it dropped. Still at levels that are a little bit elevated for my liking, but you can see definitely that these are the lowest levels. The lowest levels we have seen in quite some time. This is the beginning of the year, and this is the low. This is the low right here at 16.6. But these are one of the lowest readings that we have had all year on VIX. Yet price on the indices is not moving in the opposite direction. So really weak price action. As far as the up-down volume, you can see all stock exchanges recorded positive values on Friday. Same thing with the advanced decline issues right here. You can see on Friday was a bullish day. As far as the issues above their 50-day moving average on the S&P, you can see we definitely dropped from these elevated levels right here, and we stopped at 0.5. So still 55% of all stocks in the S&P 500 are above their 50-day moving average, and 48% of all issues in the S&P 500 are above their 200-day moving average. So what I have for you left is we take a look at the sentiment, and we are at 39 on the CNN Fear and Greed Index. Last week we were at 40. So fear is elevating, as I said, and you can definitely see that in the put call ratio at 1.04. As far as Bitcoin, we actually gained 2 points right here. We were 26 last week. We moved to 28. And seasonality, I do have this. You've seen it already. I just wanted to show you that January and December are pretty much the same historically for Nasdaq, and February is actually a very bad month. Actually the worst month for the last 20 years. So although there are some hopes that we might see some rally here to the beginning of the year, given seasonality of Nasdaq, I wouldn't expect that. And for the S&P 500, January is actually the worst month for the past 20 years. So I really urge you to be cautious when you are trading out of this 2023. It's coming next week. Of course, we're going to have another video. I'm going to say pretty much the same things, but be careful because seasonality is not on your side. And given the whole macroeconomic situation, you are not in basically in a favorite position to start buying right off the gate. As far as the models and the summary, again, the models are on sale, setups pretty much none. There are some energy stocks that are setting up again with a recent oil run, a couple of points for the last week. So this might be something that you could consider, but again, energy is very tricky and is subject to a lot of international macroeconomic situations that are into development right now. Actually, just today I was reading news that Russia is actually ready to negotiate with the Western world about peace for Ukraine. So this can definitely sway the market and oil prices one way or the other way. So it's really news-driven macroeconomic situation that I don't think that you want to be that much involved into. Again, market's negative, put volume is increasing, volatility is increasing, although not as much as the price action suggests, and of course recession and Fed high. So patience and cash is king are my two best advices right here. If you can stay out of the market or poke but very little size or be very fast, that's the best thing that you can do right now. You can get a feel for the market, but again, be very fast or trade with extremely small amounts of your account equity to preserve capital when market conditions improve. And trust me, they will. They always do. Apart from the fact that we have never had 25% drop in the market before recession, pretty much everything else is the same. And nothing really has changed through history. So markets will get better, that's for sure. Again, I'll leave you with this. Have a great, although shortened weekend of trading, and I'll see you here next week. If you do enjoy the contents of this video, please like, subscribe, really helps for the YouTube algorithm. And I welcome you to our Discord server. You will find the links in the description of the video. Again, see you guys till next time. Bye bye.